Most small business owners think there are two ways to get finance: go to the bank and hope for the best, or find a non bank lender and pay more for it. What a lot of people don't know is that if your business owns assets, equipment, vehicles, machinery, outstanding invoices, inventory, you may already have the collateral sitting right there to access finance on better terms than you expect. That is what asset based lending is, and it is one of the most underused finance options for Australian small businesses. Here is how it works. Instead of the lender assessing your loan primarily on your credit history or personal income, they assess it on the value of your business assets. The asset becomes the security. The lender advances a percentage of that asset's value as a loan or a revolving credit line. And because the risk to the lender is lower, the approval process is often faster and the credit requirements are less strict. The most common types of assets used as collateral are accounts receivable. That is your outstanding invoices, inventory, equipment, vehicles, and machinery. Real estate can also be used, but it is not required. Let me give you a practical example. You run a trade business with $60,000 worth of equipment and a ute. You need working capital to take on a larger job, maybe to cover materials upfront before the client pays. An asset based lender can use the value of your equipment and vehicle as security and advance you the funds in days, not weeks. You get the job done, the client pays, you repay the loan. Compared to a traditional bank loan, asset based lending has a few clear advantages. Approval is generally faster. The loan amount can grow as your asset base grows. So as you buy more equipment or take on more receivables, your borrowing capacity increases automatically. And businesses with less than perfect credit scores can still qualify because the lender's primary concern is the quality of the assets, not your credit history. There are a few things to be aware of. Interest rates on asset based facilities can be higher than traditional term loans for well qualified borrowers. Lenders will also conduct ongoing monitoring of your assets, particularly accounts receivable and inventory, which adds some administrative overhead. The key question to ask yourself is this: does your business have assets that are sitting idle as collateral while you are turning down work or struggling with cash flow? If yes, asset based lending is worth exploring seriously. The link in the description takes you straight to a free loan comparison tool where you can see which lenders offer asset based and equipment finance options for your type of business.